The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. He moves more markets than your average Bowden vigilante. It's Anthony Macdonald. How are you, Anthony?
The vigilante's had a bigger week than me, James.
Very big week. We'll get into that. Well, this week we take you inside the mysterious world of bond markets and explain what's got the world's most important investors grumpy. We ask why many of Australia's biggest companies don't actually seem that keen on investing in Australia. And we look at whether there's something a bit sick about your health insurance.
But first, James, we love our economic data here on the Chook Pod, and we've got some key data this week in the form of numbers on wages and employment. These are linked, of course, James, and the story for a long time has been that the labour market is pretty tight. Is that showing up in pay packets?
Sad to say for our listeners, probably not. Well, look, nominal wages are going along at an okay clip, 3.2%. But you got to remember that inflation's running a bit higher than that. So real wages, which are inflation-adjusted wages, they are rising at 0.17%. Now, in a way, a relatively muted wage outcome is not too bad news for the RBA. They don't want to see wages chasing inflation higher. But, Anthony, we know that there's more wage pressure coming in the September quarter because we had that minimum wage increase come through at the start of July. That was 4.75%. And the RBA estimates that that flows through to something like half the economy. So there's more wage pressure coming, right? So that is an issue for the RBA. They will take a little bit of comfort from the unemployment rate, which edged up from 4.4% to 4.5%. But Anthony, how much relief does that give the RBA really? I mean, it still feels like the labour market's pretty tight, isn't it?
It's very tight, James. Now, when I saw the data this week, I thought it's a good thing we work in the public service here at Nine Entertainment, James.
No, we work in the service of the public, not the public service, Anthony.
Did you see that the public service wages, they were up 0.9% for the quarter, outdoing the private sector for the sixth quarter in a row?
Yikes.
6 straight quarters.
So we should be working for Big Jim Chalmers, is that what you're saying?
No, we need to just change the conversation and call ourselves public service workers, get our pay rises. That's what we need to do.
Okay, and do you think the RBA takes a lot of relief from this? I mean, it probably means that they don't have to do anything till they see a bit more data on inflation, right? At the very least.
Yeah, and that's kind of what the economists were saying, James. They're like, nah, this is all good. Don't worry, this is a good number, good data, all that sort of stuff. But I don't know, mate. I still see those wage increases, and we've seen this in reporting season.
Yeah.
We've heard from a lot of companies now, and in their operating expenses slide, they're talking about wage increases that are driving up expenses. They're talking about what they're doing to manage that as well, which is basically cutting back hours and cutting jobs. I mean, for ordinary people out there in Australia, I mean, that's not good. It is sort of what the RBA wants to see, though. I mean, they do want to see this jobs market cooling off a bit, becoming less tight, as Michelle Bullock could probably put it. But yeah, so I think the wages numbers, I mean, there's something to worry about on two fronts, aren't they? I mean, there's the quantum, there's sort of more that the economy can handle.
Yep.
And then there's the quantum, less than enough to raise living standards. So we're in this paradox where the quantum's a problem on both the upside and the downside, depending on which way you look at it. And, you know, we're a little bit stuck in the middle.
Yeah, all right. Well, we'll just have to get into the public service, I think, Anthony. That's the solution. But I wanted to ask you about a fascinating piece you wrote on the chief executive of Medibank having a spray at the insurance aggregators. That's the companies that we see advertised a lot on the telly. It's the iSelects of the world or the Compare the Markets of the world with that fantastic meerkat that they've got. Now, the CEO of Medibank reckons that these guys are pushing up costs in the health sector. And what really struck me here is that we've all been trained to shop around basically every year for health insurance to get a better deal. So is Medibank saying this is a bad thing? And I guess, secondly, do we believe them or are they just talking their own book?
Do you shop around for your health insurance? Seriously, I reckon I've been on the same one for 20 years.
No, I think we've regularly shopped around as, you know, you get into those moments with kids, like when the kids need braces. That's often you know, how do we get the best deal and the best coverage?
Yeah, well, you're better than me, but I mean, in terms of your question, James, I mean, one thing we know about CEOs on results days is they always talk their own book.
Yes,
you know,
that's true.
That's rule number one.
True.
I mean, Medibank uses these comparison sites for its number 2 brand, which is called AHM, which is it's kind of cheap and cheerful brand. You know, its version of Qantas's Jetstar or Telstra's Belong Mobile. And it uses these sites to win customers. It can win half or more of its new customers that way.
Okay.
So they have been an important part of its business. The problem is, though, these aggregators, as it calls them, are getting more expensive.
Right.
David Koska, Medibank's CEO, says they can charge 25 to 30% of a first year's premium, which is a lot.
Yeah.
Considering that you've got customers like yourself, James, that are willing to switch, every time their kids need braces, which is, 4 times during their lifetime these days.
Yeah.
So basically, the insurers are paying nearly a third of that first year premium to keep someone for maybe 3 years, 4 years. And it adds up, right? And Koska's point is it adds up in a sector where costs are closely scrutinised. Remember, the private health insurers, they have to get sign-off on premium increases every year. Part of that is their cost base and thinking about the cost base, cost recovery. So he reckons these aggregators have got a lot more aggressive. Their commissions are up 44% in the past 2 years. And instead of bringing people into the sector, which is what he'd like to see, they're just encouraging switching between the funds. They're not actually serving a greater purpose rather than just churning people between funds. So, James, considering he's against the aggregators, do you think he stopped using them altogether?
I was going to say, what's his solution here, Anthony?
Yeah. Well, he said he didn't renew a contract with one of the aggregators, which means Medibank or AHM just drops off the site, right? And he says that's also part of the problem because customers do these things thinking you're getting a proper view of the entire landscape, when in reality you're just getting the people that have paid to be on there. I mean, he is a willing participant in one way, but he's trying to blow the whistle at the same time saying, hold on, let's think about this. None of us like our private health insurance premium going up 5% a year or whatever it is. This is a cost that's now meaningful in the sector. It's one we don't really think about. Let's step back and think about it. And it hurts Medibank probably more than others because it is big, right? Yeah. Number one by market share. It and Bupa, they're the two big in Australian health insurance. It's not using aggregators for its main Medibank brand, using them less. In this AHM, it flagged that with investors. It says just be a little bit careful of the volume number for a little bit because we are changing the way we use these aggregators. It might be a little bit soft. But, I just thought this was a rare corporate Barney.
Yeah, absolutely. And Anthony, is he suggesting there might be a cause for regulating these aggregators? Because I hear what he's saying, but they also encourage competition. We like competition in markets. So, I don't know, is there a way to regulate or cap the commissions that they charge perhaps, or is there another solution?
Yeah, it's one way. I mean, I think what he wants more now is just sort of a bit of an investigation into what they're doing for the industry and whether it's adding value or not. And, if there's an adverse finding from that, then yeah, sure, maybe let's talk about regulation or something. But just as a general rule, James, I'm not pushing more regulation on on anything at the moment. If anything, I think we should be more trying to keep our deregulation hats on.
Yeah, no, good call. Let's watch this space. I reckon it's an interesting one.
Sure is, James. Okay, for our first big topic today, we're going to wade into the big, mysterious world of the government bond market, which has been at the centre of a week of incredible drama. Now, I know the bond market can sound like a bit of a scary place, so before we get into it, I reckon we do a bit of a bond market Q&A for our listeners to try and demystify it.
Yeah, great idea.
So let's go. You start us off, James. What actually is a bond?
Well, a bond's essentially a loan to the government. So the government promises to pay the lender an agreed rate of interest each year. That's called a coupon. And then they pay the amount actually lent at the end of the period. So if you buy a 10-year bond, say you buy $100 worth of 10-year bonds, you get a coupon every year, an interest payment at an agreed rate. And then at the end of the 10 years, you get your $100 back.
Yeah, and then why do governments issue bonds?
Well, it keeps the wheels of government turning, I guess. Now, governments need to spend money on all those public service wages, on hospitals, on roads, on all that sort of thing. And, governments need money all the time, even when they're in surplus, but especially when they're in deficit. So that's why governments go to the bond market to keep finding money to keep the wheels turning.
And when they go to the bond market, who's on the other side? Who's there actually lending to the government?
This is a question we get a bit on the Chanticleer podcast. Who actually lends to the government? Now, it's lots of people. So other governments and other central banks, they buy bonds, government bonds, because they're good places to park cash and earn a return. And you might also do the same if you're a pension fund, if you're a super fund, or if you're a big institutional investor, because, again, you want to park your money somewhere that's seen as safe, in inverted commas, and earn a nice little bit of return on the way through. Individuals can buy bonds too, but it's largely dominated by those big investors and governments.
Now, whenever we read about bonds and bond vigilantes and whatnot, I mean, you often dish this up first thing in the morning for our readers and they love it. The talk's always about yields.
Yes.
So what is a bond yield and how do we sort of figure it out?
So if I buy a 10-year bond, I might get to year 5 and I decide, geez, I need cash for something else. I've got a new boat I've got to buy, or someone's wedding that I need to fund. So you might decide that you need to sell the bond before that 10 years is up. And this is where the bond market comes in. So every day, billions of dollars, hundreds of billions of dollars of bonds are bought and sold. And the price of those bonds changes depending on lots of things. Now, say you buy a 10-year bond with a 5% interest rate or coupon tomorrow. In 5 years' time, when you decide to sell the bond, the rate of inflation in the economy might be different. So that 5% yield might need to be higher or lower, adjusted in some way to reflect those changing circumstances.
And what do higher yields actually tell us, other than the government's effectively sort of paying more for its debt?
Yeah, so the bond investors want to receive a greater amount of compensation for the risk of lending to the government. That's what the higher yields tell us. So think of it another way. As the yield on a bond rises, the price that a buyer is willing to pay for the actual bond falls. So that's why we often say yields rise, prices fall when it comes to bonds.
Okay, this week was all about rising bond yields around the world. I mean, in the US, the 30-year government bond yield hit the highest point since 2007. That's pre the GFC.
Yeah.
In Japan, 30-year yields went to 30-year highs. German, French and British yields are at multi-year highs as well. So what the hell's going on?
So bond investors are worried about a few things. They're worried about the war in Iran making oil prices worse, which will push up inflation around the world, and particularly in some of those economies where they have to import a lot of their energy. They're particularly exposed to inflation. They're worried that government debt is crazily high. Now, the US debt hit $40 trillion US this week, which is a special milestone. And we even got a milestone down here because Australia's national debt briefly went through the $1 trillion mark for the first time in history. What bond investors are also worried about is AI. Now, we've talked a lot on the podcast about how big tech companies are now selling bonds too because they need to try and finance all this AI infrastructure spending that they're doing. And Anthony, we actually saw an example of that big tech fundraising spree in Australia this week, didn't we?
Sure did, James. The big fish landed.
Yes.
And that was Alphabet, owns Google and YouTube. Number 3 listed company in the world by market cap, about US $3.5 trillion. Oof. One of the big AI companies, AI spenders, got that big Google Cloud business, which sort of lets individuals and businesses rent computer power, data storage, network infrastructure. I mean, we're on the Google Docs at work. James, I imagine that's all running through the Google system and the Google data centers.
Yep.
They came to Australian bond investors to raise capital this week. It's called a kangaroo bond.
Oof,
nice little name, but it's basically an offshore issuer selling bonds in Australia in Australian dollars. So this is basically Google going to Australian investors in Australian dollars saying, can we have some money and we'll pay you back, like you said, in 3 years, 5 years, 10 years, 20 years, etc. But I mean, it was big news here. It's been a big year for these kangaroo bond deals in Australia. There's been a bunch of first-time issuers. So offshore companies come to Australia for the first time to hit our bond markets. There's been some good returning ones. Bankers were saying, yeah, that's all good. We like the activity, but just wait for the big fish. And the big fish was one of these hyperscalers, one of these big US data center cloud computing businesses. Alphabet's obviously one of the big ones. Microsoft and Amazon are the other two big ones. So, I mean, this has sort of been building for the past few weeks, right? So at the same time, these hyperscalers, as they're called, the big tech companies, they've been raising bucket loads of money in bond markets, which is sort of one of the biggest shifts in the investment landscape over the past couple of years. These companies are huge. They have massive free cash flow. They are absolutely creaming it in their existing businesses.
Totally.
But what they're doing is they're investing so much in data centers and AIs. They actually need more money than that to keep investing. And the more money is they're raising mostly via debt, and that's through bond markets. So you've got they've had these pristine, strong balance sheets, and now they're packing them with debt to build the data centers to sort of keep this AI build out and roll out going. So, I mean, Alphabet came here. It ended up with $5.5 billion, the biggest ever corporate bond deal in Australia. More than 200 investors bought in. The brokers reckon they had $18 billion of bids between them. Wow. So huge, right? Broad participation. Like this is our SpaceX sort of thing. The SpaceX IPO, biggest IPO in the world, US, whatever. Australia, little bond market equivalent is the Alphabet bond this week.
It's a great example, isn't it, Anthony, of what is happening for government bonds, though. If a Google or someone comes into the bond market and tries to raise money, then that creates competition for these government bonds, and the governments are forced to offer a more attractive interest rate to get their bond deals away. It's this competition that's become an issue.
Yeah, 100%. It's competitive for money, and it was good. Alphabet didn't get its money for nothing. The Aussies, I thought, did okay out of it. I mean, the 3-year bonds priced at 65 basis points above the swaps. I mean, that's about a 5.25% yield at the moment. The 20-year bonds about a 6.98% yield at the moment. You can buy Alphabet debt and expect to get your sort of 7% a year. That's what that's saying, and to me, I mean, that sounds like a good sort of level, right? Like money's got a cost, which is good. And Australian investors, there's actual income there for them.
Yeah.
So anyway, there's been lots of concerns, James, about this rise in bond yields. I mean, it's bad for share markets too, because if borrowing costs go up for the economy, that has to make it harder for companies to earn profits in the future, which pulls down share prices today. But then on Wednesday night, we saw something quite amazing. So the US Treasury Secretary, a former hedge fund manager named Scott Bessent, he decided he'd just had enough, right?
He did. Yeah, so before the market opened on Wednesday night in the US, we got this press release from the US Treasury saying, we are going to double the amount of bonds we're buying back. So the US Treasury wades into the market and buys long-dated bonds, so that's 10-year bonds, 20-year bonds, 30-year bonds. It buys them, and it said it was doing this for liquidity purposes, to ensure there's enough liquidity in the market. But everybody went, come on, mate, pull the other one. What you're doing this for is to try and force down the level of bond yields. So having seen that US bond yield hit a 19-year high, that the 30-year bond yield hitting a 19-year high of 5.3%, Scott Bessent wades in and goes, no, I need to bring that bond yield down. And all of a sudden, we've got this liquidity operation. Now, it worked, Anthony. It worked initially. The 30-year bond yield did come down to about 5.2%, but then by Thursday night, the impact of Scott Bessent's intervention in markets was completely wiped out. The bond yields just went straight back up because none of the issues have changed.
Yeah.
Government debt's still high, inflation's too much of a worry, AI fundraising's still going on. None of the fundamentals have changed, and bond investors just went, nice try, Scotty, but not this time, bud. So I think we're going to have this pressure, this upward pressure on bond yields around the world continuing, Anthony, and that will put pressure on share markets. But look, we have seen these bond market rumblings before. It seems they're becoming more regular, really. Do you think markets can eventually shrug this off and get back to getting excited about AI again?
Yeah, markets do, but it's the governments that struggle to shrug it off, James. I mean, we saw that last year with the tariffs, right? It wasn't until the bond markets really started freaking out that Donald Trump sort of backtracked on the worst of the tariffs. Basically with bonds, like for me, I've always thought about it, like everything's bigger in bonds.
Yes.
Like seriously, like we spend nearly all our time talking about the share market and stocks and what they're doing. But when governments want to trade, when they want to borrow, when they want to implement monetary policy, when they need to balance the fiscal policy, any sort of intervention really, they do it in bond markets. Then they do it there because they're the biggest, most liquid, most traded market in the world. It's the market that sets the price for just about every other asset. Like when you do finance in uni, James, you talk about the risk-free rate, and the one you use is the US 10-year Treasury, right? It literally starts there, that Treasury yield, that government bond yield in the US. And so when that 10-year government bond yield moves up or down, asset prices pretty much across the board move up and down with it. So even if you're an equities investor here in Australia, the first thing you look at when you get up in the morning is that US 10-year Treasury yield, because it acts as the thing that reprices all the other assets, but it's also a sentiment indicator as well, and it's a liquidity indicator as well in markets. And when there's big jumps in that US 10-year, and there actually has been big moves this year, I mean, it shows you that there's sort of uncertainty and volatility out there, right? And it's sort of like, buckle up, we're in for a big ride. So, I mean, that US 10-year bond yield, it peaked in the 4.7s this week, James. It's back in the 4.7s on Friday morning. It was in the low 4s a couple of months ago. I mean, that's a big shift, right? When you're talking about valuing all the assets in the world based off one number, and that number's moving around so much, it just spells volatility. I mean, and if it keeps going up, makes it really hard for equity markets to keep growing up, because all those future cash flows in the future, they get discounted even harder, which in theory makes companies worth less today. And it's a real sort of headwind.
Yeah, if it gets to 5%, Anthony, things are going to get really exciting, aren't they?
Sure will.
Okay, Anthony, we've had another one of those weeks digging through profits, talking to CEOs and investors, listening to analyst calls, and thanks to everyone who's given up a bit of their time to help us pull together a better picture of what's going on in profit season. But we wanted to take a bit of a different look at reporting season this week and talk about what we're missing, or something we're noticing that is missing. And that's companies investing in Australia. They are struggling. One of Australia's big productivity problems is business being unable or unwilling to invest because they don't feel the policy settings are right, they're too worried about the cost of energy or labour, or they don't think growth is here. The economy's growing at not much more than population growth, and that is not a good backdrop for investing. Anthony, for the most part, results are backing this up. We're getting cost-out programs and lots of tinkering with volume and price to, manufacture what have generally been pretty solid results. But there's not too many companies putting their hands into their pockets and preparing to invest shareholders' funds in something that could be game-changing. Anthony, like me, you've spent the week on the phone to CEOs. Why do you think this is? And do you think we're in a bit of a pause here, or are we really in a rut?
Well, it's a pause for now. And the risk is the longer the pause goes, the more you get yourself into a rut.
Yeah.
And the harder it's going to be to get out of it. I mean, there's a few things going on, James. Number one, the growth outlook for Australia and the Australian economy, it's just not good, right? We're expecting 1.5% GDP growth here this year, next year. That's not good. I mean, most of these CEOs, they've spent their careers working with Australia, getting a pretty easy 2.5%, 3.5% GDP growth, right? So you've always got this sort of tailwind, this automatic growth. And a lot of our growth at the moment is coming from population growth. It's not like you're selling to customers that have more money in their pockets. If anything, there's just kind of a few more customers out there because the population's growing. So, I mean, it's not really a great environment. I mean, consumer sentiment is low. So the feedback you're getting from customers every time you push up the prices is worse than usual. That doesn't help. I mean, the uncertainty in the economy more broadly, James, about the interest rate direction. I mean, 3 rate rises this year has hurt. Is the next one up? Is it flat? Don't know. But we're at the level here where there's sort of pressure on borrowers already and potentially more pressure should the RBA raise rates again. The Iran war, petrol prices early this year also didn't help. That was a huge hit for consumer confidence. I mean, the other thing, James, is so these CEOs, they go out and talk to their investors and it's hard to know who actually leads the conversation between investors and companies at the moment. But I think they're both sort of a bit down in the dumps and they're both talking to each other further down in the dumps.
Yeah.
Neither one's really expressing huge confidence about the world. The CEOs will go out and see their investors and the investors aren't really on their tail to push the growth. CEOs are like, okay, well, I'll just keep doing what I'm doing, play it safe. And if I run a big company, I'm going to get this influx of the index money and hopefully that helps my share price drift higher. I basically just got to not stuff up.
Yep.
And then overhanging it all here in Australia, James, and you can never escape it, this whole house price story. Like, it's funny. There's not many companies that we talk to where the CEO is actually involved in selling houses. Like, I think there's probably one REA. You spoke to them, right? And that's more of a listing story. But there's not many. I mean, the banks, yes, but it's just what's happening with house prices, the government, politics around it all is really sort of sticky at the moment. I don't know if it's going to end up being a giant distraction or if it's the actual story, but it's there.
Can I throw another one in, Anthony?
Go for it.
Now, for a lot of the big miners, they're chasing copper at the moment. And a lot of that copper is overseas. So the investment options for these guys are mainly in places like Argentina and Chile and far off places like that. It's not like the last 30 years when for BHP and Rio, a lot of their best investment opportunities were in Australia. So there's a bit of a shift there too from a geographic point of view. Anthony, you've written a bit about dividends this week. Those companies that are beating dividend expectations, so that's paying out more of their profits to their investors, are getting handsomely rewarded. How does this fit into the reinvestment in Australia story or the lack thereof?
Well, it's an old chestnut, James. So companies, when they have this excess capital, they can either return it to shareholders via dividends or they can try and reinvest it themselves. And there's always this tension between investors and management teams about what's the better way to do it.
Yeah.
I mean, what's unusual this reporting season is we know that investors like their dividends. It's a fact of life.
Yeah.
They give me my 50 cents a share back and I'll bank it and go do what I want with it. They absolutely love it. But it's normally a sugar hit. Shares don't normally trade based on the dividend and dividend expectations so much. It's normally about earnings growth and the future earnings of the company. That's normally what sends shares up or down on results day. But Macquarie strategist Matthew Brooks, he got to the end of last week and he said, hang on, there's something unusual going on here.
Yes.
It's actually dividend expectations and dividend payments that are dictating up and down on results day. And I mean, he said, this should correct itself by the end of reporting season. But then this week, we've seen companies go up and down based on dividends, right? So we had a Horizon on Monday, the big coal carrier, soft dividend guidance, share got smoked. Challenger on Tuesday, dividend beat, shares up. On Friday morning, James, your mates, GYG, had a monster dividend from out of the blue. Shares up 10% on Friday morning. So the market's really rewarding these dividends. You could say, is it the actual dividend or does the dividend reflect the year? But these dividends are a consistent sort of factor across it. And it's worth watching because the question is this just a moment in time or is it a structural change? Because remember, we just come through the budget, which removed the CGT discount, which was a carrot to invest in growth stocks. Australia's economy isn't growing like it used to. Growth's harder. So we've got these big mature businesses with big market shares like Horizon, like Challenger, almost acting sort of like capital trappers where they just want to trap this capital in and they're going to pay a good yield and investors are going to be happy and they'll be rewarded for it. It's good if you own shares in them, but for everyone else, it's like, how's that growing the economy?
Exactly.
What's that actually doing more broadly? So that dividend versus capex to invest in growth, great chestnut. And I would say right now it's an even better sort of thing to watch than usual, because there's just so much of it going on.
No, good spot.
Now, James, we've got to think about the super funds here because they're the biggest investors in Australian shares, right? And I'd say they're the ones getting the most time with CEOs and the most space in CEOs' heads, just given the sheer volume of shares that they own. Where do they fit in here? And I want to bring in a question from Victoria in Sydney. I wrote a column saying when listed companies get pretty cheap bids and investors celebrate, we're in trouble. Like there's something wrong with the market. Anyway, Victoria says this is partly driven by the ASX 300 benchmark test, which is the performance test we've been talking about a lot here on the podcast, James. And she says it feels like Australia's caught in this conservative index-hugging malaise, resulting in small and micro-cap companies being overlooked for investment by super funds with a contagion effect to the broader investment community. She says that she's a big supporter of the super system and super should be managed in accordance with fiduciary duties. And the size and liquidity challenges these funds are under makes it hard for them. But are there any opportunities for win-win outcomes here?
Well, there's an opportunity for a win-win outcome for Victoria. If she can find the winners in those small and micro-cap companies, she's going to make some serious coin because they are undervalued. Victoria's absolutely right. The super funds, partly because of their size, it's hard for a big super fund to get a big stake of a very small company. The numbers just don't work. And partly because of that performance test, they are mainly flowing funds towards the biggest companies on the market. I think that's well established and a big trend. Now, I think most, Anthony, of the super funds are looking amongst smaller companies for bargains, but it's just harder for them to put lots of capital to work there. And so, yes, Victoria's right. We are seeing many of these companies beyond the ASX 300 be overlooked. It's not great for dynamism in the economy. We don't want to see small and potentially exciting companies sort of starved of capital. But I'm not entirely sure what the solution is here, other than people like Victoria hunting for wins in this area. Is there a structural solution here, Anthony, or is it just up to active investors to say, hey, this is where the fun can be had? We've got to look here.
No, for me, there's a structural solution for sure, James, and that's the performance test. The way that it's disincentivized super funds from taking risk, from investing away from the benchmark. For me, you change that, it can completely change the capital flows. There's no question about that in my mind. And I quite agree with Victoria. Like, this is retiree savings. Let's let the super funds invest it like they want to, right? And some of the guardrails they put up around the performance test, very well-meaning, but we can see 5 years on, it's distorted capital flows in a way that's not working for the economy. And for me, James, that's a big thing because your super, right, that you put in, 12% of your pay every week. That's your retirement savings, and the outcome that is best for you is the number one goal. But let's also remember from the country's perspective, this is tax-effective savings scheme, right? So in your super, you pay 15% on your contribution, 15% on your earnings in accumulation phase, 0% tax on investment earnings in the retirement phase. So it's probably the second safest investment you can have in Australia outside paying down your mortgage, James, right? The concessions are generous. So while they're people's savings, what value is the country getting for giving you, me, 19 million other Australians in the retirement savings super system? What benefit is the country getting for that? And is that sort of value enough? Because remember, the tax base will shift over the next 10, 20 years, right? It needs to move more away from income. Wealth and assets are going to attract more tax, right? We're seeing that already. Is the super system working for the country still as a whole? I mean, there's benefits they have, very obvious benefits it has, but I think we need the super funds to be thinking a bit more broadly about their role in society rather than just trying to tip 12 cents in the dollar into, CBA shares.
Yeah, I'm hearing where you're coming from, Anthony. Changing the performance test does involve society as a whole accepting more risk in order for a better return. And I do wonder when we have the next inevitable correction on share markets and small and mid-cap companies get absolutely smashed, whether we'll say, oh, hang on, why has my super fund hugely underperformed the ASX 200? Now, I agree with you. We should be able to say, hey, you're investing here for 30 years. Don't worry about 1 year or 1 quarter or whatever it is. But that conversation's not an easy one. So, look, there's a review of the performance test going on at the moment. I think that review is healthy and welcome. Let's see where it comes out. Anthony, let's finish on a happier note. Can you think of any companies bucking the trend and actually doing some good investment? And what is it that's allowing them to do it?
Yeah, gas pipelines owner, APA Group, James. I mean, huge gas pipelines that transport gas from gas fields to where it's used, like not your house, but sort of like towards the cities and the industrial areas. I mean, the backbone of its business is a regulated business, right? Like it can charge customers a certain amount. It's like monopoly infrastructure from these gas fields. About 5 years ago, there was heaps of uncertainty around it, because it was in gas, right? And the role of gas in the economy, gas was a dirty word, and it was an absolutely free pass for this company to get kicked around. It was copping heat from investors, from regulators, all sorts of reviews in and around it. And it was on a bit of a hiding to nothing. It was trying to expand more broadly outside of gas. But while there were these question marks over gas at the central of its business, it sort of didn't really have the license to do anything. Shareholders were just like, mate, run this thing hard and give us as many distributions as you can because this thing might not be around for the long term. But anyway, about 2 years ago, the Labor government came out and they said that, gas will play a crucial role in Australia's energy transition. And all of a sudden, like the doors started opening for this company, APA Group, and the CEO, Adam Watson, is just like bolting through them, right? So they've got lots of little projects on the go. I mean, the most recent one they announced this week was a solar farm and battery up at Mount Isa in Queensland, backed by one of the big gold copper miners, Evolution Mining, which is a customer up there. But yeah, I mean, Adam Watson's doing a good job he's growing the earnings in the business. That's the number one thing. And he's growing distributions slowly, but he's growing earnings above distributions. And that tells you that investors are happy for him to retain more of those earnings inside the business to keep investing. And it's kind of working for them at the moment. But it's only possible, though, because they've got this rethinking of gas behind them, right, which helps fuel it. So, yeah, I mean, that was one that stuck out to me. And APA Group's last few results, they've always sort of got some sort of expansion news on results day. It's quite noticeable, right, because there's not a lot of that more broadly. What about you? Anything you're seeing that's bucking the trend?
Well, there's two big companies still investing a lot. Telstra is one, putting billions of dollars into digital infrastructure, basically a cable network. It's called the Aura network that's going to be running across the country. Look, if we want to become an AI powerhouse, that sort of infrastructure is going to be vital. Telstra thinks there's good returns, mid-double-digit returns in that, so it's continuing to invest very heavily. The other one's BHP. Now, they've got a copper investment program that's, worth about $50 billion US. Yes, most of that's going to go offshore, but they're still proposing a investment of around $10 billion US in their Olympic Dam copper business in South Australia.
Wow.
So there's not many companies out there going to drop $10 billion US on a project, which is what we could see from BHP over the next few years. So, don't count the big Australian out yet. They're still doing some big spending in this country.
Sounds like it's fighting back against firms, James.
Yes, exactly. All right, Anthony, we're back after the break and we'll preview a special meeting of the minds between the Prime Minister and the business community. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Now, Anthony, you've heard us on the podcast, you've read us in the newspaper and at afr.com, But do you want the chance to see the chooks strutting their stuff live on stage? Then we've got just the event for you. On September 23 at the Fullerton Hotel in Sydney, we're holding a very special Chanticleer lunch. And Anthony, this is a cracking lineup.
Sure is, James. The whole event's going to be a cracker. We've got the Productivity Commissioner, Danielle Wood. She's on stage, leading fund manager, Dion Herschen. We've got the founder of Beta Shares, Alex Vinocour. We've got Jane McAloon, one of the best chairs in the country. And to top it all off, we've got Greg Boura, who's one of the godfathers of the AI trade in Australia. I mean, this guy's been building data centres literally for decades.
Yeah, we're going to thrash out the big question. How do we make the Australian economy bigger, better and more dynamic? Anthony, I think this is going to be really good fun. And anyone who gets along, they might even get a chance for a selfie with you, mate.
Lucky them.
So head to live.afr.com/Chanticleer lunch, and we hope to see you there. All right, Anthony, before we get to that Chanticleer lunch, we've got a few big events this week. Results season rolls on into its final frantic week. On Monday, we've got Ampol and Bendigo Bank. On Tuesday, Coles Woodside Centre, the big shopping centre owner. On Wednesday, we've got Woolworths and WiseTech. On Thursday, we've got Wesfarmers, Qantas and Sigma Healthcare. Virgin Australia wraps it all up on Friday. Anthony, who are you looking forward to most out of that mob?
All of them. I don't know, James. For me, it's Coles versus Woolworths week.
Yep, I agree. And to top that all off, Wesfarmers, which owns Bunnings, will be really interesting as well. On economics front, we've got on Tuesday the RBA board minutes, which will give us a little view inside the thinking of the Monetary Policy Board. And then on Wednesday, we've got inflation figures for the month of July. Anthony, I'm not sure we're going to get too much more information on where the RBA thinks rates are going out of all this, but it'll confirm a few things maybe.
Yeah, absolutely. Price is still going up more than the board would like them to.
And on Tuesday, Anthony, we've got a special event that the Business Council of Australia is holding. It's its annual dinner, and they've got a special guest, the Prime Minister of Australia, Anthony Albanese. Now, do you reckon the words productivity and growth might be mentioned at this dinner?
Yeah. You mean how many times per minute?
That's what I meant, yes.
Look, big business not happy with the PM, Anthony Albanese. I'm not sure whether they say that directly to his face. And there's many words or not, but yeah, I mean, there's plenty of issues to mull over.
Yeah, and then look out for on Friday night next week, we get the Fed chairman, the Federal Reserve Chairman, Kevin Warsh, is giving his annual speech at the Jackson Hole Symposium. How good would it be to go to the Jackson Hole Symposium, Anthony? Just sounds awesome. So watch out for that. That could be a real market-moving event given all the stuff that's happening in bonds at the moment. All right, Anthony, we love questions on the Chanticleer podcast. This week, our question's from Andrew in New South Wales. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone and include your name and where you're from and email it to us. And there's also the widget on all Chanticleer articles at afr.com. So we will ask our super producer, Iona, to do the honours with Andrew's question.
How do we get the debate about productivity away from the idea that the government has to do something and back to the business and investment leaders of Australia, whose aversion to risk is significantly more responsible than any policy of government?
Well, Anthony, I think we could take that as a little bit of question and a comment. I'm not sure I agree, Anthony, that the aversion to risk from the business and investment community is more responsible than any policy of government. I think government needs to show the way here. Andrew's right, it is a partnership, but government does need to set the right conditions for investment to flourish. And I'm just not sure they've done a lot of that in the last few years. There's been increase in government spending. Andrew Irvine, the CEO of NAB, told me this week that over the last decade, 9 out of 10 jobs have been created in the public service. So there's an argument that, that's crowded out job creation and dynamism in the economy. But yes, I think as we talked about before, we do have a bit of an issue with business leaders not wanting to pull the trigger on investment for lots of different reasons, including the macro environment. And I think the business community has become a bit timid. It's easy to, as you put it, Anthony, trap that capital from the super funds and just keep cruising along. So yes, I reckon business can do with a kick up the pants, but it should come from a government that's saying, here is the conditions that we are giving you to make investment flourish. I don't know, Anthony, have I got that wrong?
You know what we could do, James? Invite everyone to Canberra for a 3-day roundtable. That'll work. The party like it's 2025 all over again.
Good
what a disappointment. But at least that roundtable did get business thinking about things, and they, offered up so many suggestions, and it was great. This time last year, we were all talk about it, and hasn't that fallen flat?
Yeah.
It's a real chicken and egg problem, this one, Andrew. I mean, both sides are pointing at each other as the problem, man. Which one do you actually need first? You need the tax incentive and the IR laws and everything in place before business invests, or do you need business to take the leap of faith? I mean, I personally, I think you need the government policy first, but maybe I've just been talking to too many CEOs because that's what they say. But listen, we need both sides to jump in together, because if they don't, we're growing at 1.5% a year forever, and my kids are going to have worse life than me, and their kids are going to have worse life than them, and we're sort of going backwards. So we don't want that.
Yeah, no, we need a circuit breaker, and I think the circuit breaker probably needs to come from government leadership. But Andrew, you're right. Business needs to dig in and pick up the slack too. All right, Anthony, well, we'll have another chance to have a look at the investment intentions of corporate Australia across this final week of reporting season next week, and there's some big companies that's going to be great fun to dive into, I reckon.
Sure will, and good luck for footy finals on the weekend, James.
Oh, thank you. Go to the Mitcham Tigers in the under-14s. It's very exciting times. Hopefully I'll be reporting back to you next Friday with some good news about the boys. All right, Anthony, have a great week, and thanks for listening, everybody. We'll see you next week. If you like the podcast, share it with a friend. And if you want to read more about what we've talked about today, check out the links in the show notes. And don't forget, you can listen to this and all AFR podcasts on the AFR app. At the Financial Review, we investigate the big stories about markets, business and power. You can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Iona Rennie, our theme is by Alex Gow, and the head of premium content is Fiona Buffini.
The Australian Financial Review.